Welcome into the Fearless Investor podcast. We have a brand new name, a brand new logo, a brand new brand. And the whole reason, if you notice, we didn't change a whole lot. I didn't want to completely do a 180 on you guys. I just noticed I wasn't talking about flipping a whole lot. And as we start to notice, as all this coronavirus stuff continues to go on, the importance of diversification, education, and investing, and how sometimes when real estate gets to that point of just a standstill, a pause, it's time to start looking at, is real estate where I want to stay? Do I want to go into different areas? And I don't know about you, I'm staying in real estate, but I'm also broadening my education, broadening my horizons. And as you know, I believe in staying in one lane. My lane is Airbnb. And then I educate myself about all the other ones. So when an opportunity comes my way, I won't let it pass by. And that is exactly what our first episode of The Fearless Investor is all about with Lior Gantz. And Lior is coming to us from across the seas. He is a expert on stocks and expert on passive income through stocks. Now, that may sound to you like something new, something maybe not up your alley, but I really encourage you to listen into this. Lior is an abundance of knowledge, and he's got a really special offer, both a free one and a discounted one. By the end of this episode, you're going to be jumping at what he's got. So let's jump into it right now. The very first episode of The Fearless Investor with Lior Gantz. Hey, welcome into the very first transition episode of The Fearless Investor. And we've got a very special guest today, Lior Gantz, the founder of the Wealth Research Group, which is wealthresearchgroup.com. And Lior, tell our audience where you're calling in from today, and looking forward to having you on the show, man.
We are currently in a full nationwide curfew. I'm in Tel Aviv. It's Passover today, and because it's such a family-oriented holiday, the government's put checkposts literally every few blocks, and you cannot leave the house.
It's crazy. So, I was talking to a friend yesterday about Easter here in the United States, and I was like, that's this Sunday? We're not even like, people don't even know. I just had another interview where I'm like, Is it Wednesday? Is it Sunday? What day are we on? I'm losing track of like what even the month or the year is really at this point. But Lior, thanks for being on the show. And I got to ask you, what is your most interesting investing story that you can share with our audience?
One that comes to mind is September of 2008. Mid-September, I'm booked on a rafting trip, 4-day rafting trip in the Green River, Colorado. Me, my girlfriend, now my wife, and my brother. And we go down to the riverbank and we head off for like 4 days, and no cell reception, no nothing. Really, it's just nature, epic stuff. And when I come out of it, the markets literally in those 4 days, this was not the Lehman weekend, but it was like the pre-Lehman weekend. So I'm looking at my phone and I'm looking at the text messages, and the world was on fire. And it really gave me a lot of perspective about panic in the markets, and how markets function in massive forced liquidation events, which is what we saw, Kyle, last month, where people just sold no matter what the price, and what fear can make people do.
Yeah, absolutely. So, well, that's
like
quite the
4 days with no reception.
Yeah, quite the vacation you come back to, and the world is completely flipped upside down. So
yes,
that's wild, man. Well, hey, let's get to know you, Lior. I know you've got a very interesting story. You have a lot of content out there in the World Wide Web, and a lot of people are going to just get a little bit of a taste of you here today, and probably want to go continue to learn from you. But can you just give us, some background of who you are, where you're from, and what brought you into this world of investing?
Yeah. So my father was a businessman, and he was in the furniture business, upholstery, etc. And when I was 13, he had his first problems with liquidity, etc. And his business basically went under. And when I was 13, I needed to start working for myself if I wanted money, if I wanted allowance and whatnot. So I literally started working for myself when I was 13. I handed out flyers in my own neighborhood, coached basketball to like the first graders, babysat them later, like upsold them, we say today, right? Upsold the parents.
That was your back end sale.
Yes. And then by 16, after painting decks and doing in the summers, I used to put the flyers on the windshields and everything like that. So I got about 20 grand worth of today's money in the bank account when I was 16. And
Wow.
you know, I come into the bank to the bank, and the guy, the bankers, what are you doing? You're 16. How do you save up money? And I told him I'm working. He said, look, you should sign a waiver, get your parents to sign a waiver, and then you can invest as a minor. This is June 2000. I'm 16, and this is 3 months after the dot-com bubble burst. So it's really actually a good time, you know, in retrospect, to get into markets.
Right.
And I do that. My parents come in. My mother comes in, and she signs that waiver for myself. And then I started to invest when I was 16. I started investing by asking my grandfather, hey, who's a good investor? And he said Warren Buffett and Peter Lynch. Probably, I don't know if many people know Peter Lynch, but Warren Buffett's pretty big. And I bought the book, started reading, and ended up reading like 100 books in my first, between 60 and 70. You know those Hollywood movies where the book is inside the book, and the guy's in high school and reading that book inside.
Yeah, that was you.
Yeah, that's me. I'm like doing the Buffett stuff, and they're all learning about history or something. So yeah, that's how I started investing. And then those investment books also got me into the book sections of like personal development and entrepreneurship, etc. And then I really got into, you know, understanding that entrepreneurship and business is the right way to go for if you know what you're doing. So then my father goes belly up again for the second time. I'm 18, and the third time when I'm 22. So I know by that time there's no, because that literally was like a full bankruptcy. So I knew that this is no parachute, and be on my own. So that's basically the background. And 4 years ago, because of the value that I saw in summarizing, I would say, or really dumbing down these hundreds of books and lessons, etc., that people used to ask me anyways, I said I will found a free financial newsletter. I will launch it, and I will basically summarize what I read every day and my insights inside of the newsletter. So that's where it is. It's basically how you can just my 6 to 8 hours a day that I do, you know, investing in entrepreneurship in my own business, and I funnel that into a 6-7 minute read.
Wow. And that's where wealthresearchgroup.com, that's where people can find that?
Yeah, that's the free newsletter. You can sign up on the homepage, and if you click on the top menu, it says special reports. That's like a library of PDF downloads that are for free from everything from gold, silver, governments, this virus, obviously, and everything that's going on. It's all PDF, and it's great reads, you know, to kind of build your education and because that's what I think is basically the problem for most people. Most people want wealth. Most people want a great life. And I think each is somewhere on that pendulum that something's missing, and any further insight could be the next thing. You know, it took me so long to break out that I know the struggle. I know how it is. And that's basically the passion that I have to bring that further information.
That's awesome, man. I mean, that's such a great service to people to be able to, you know, with so many different books, so many different resources, so many different videos and podcasts and everything, to be able to go to one place where it's literally you are expanding your mind, you're expanding your research, and you are able to share with people what you're seeing and all of these trends and all these different things. That's a really great service that you're providing. So thank you for doing that. And I gotta ask the follow-up question that with all the research that you've done, the $1 million question to me is, what do you see as the best investment out there?
So historically, the best investment to make, if we're not philosophically speaking, obviously, philosophically speaking, the best investment is in yourself.
Yes.
But if you're looking to put money to work, historically, looking at a chart actually from 1812 until today, so that's 208 years worth of research. Every $1 invested in American enterprise has turned to about $700,000. Every $1 invested in American blue chip stocks. So over that time, though, there have been probably tens of times where American blue chip companies or the S&P 500 in the last 60 years since it became an index, etc., that those have suffered through 50 and 60 and 70% drawbacks.
Mm-hmm.
So not a smooth ride, but the compounding effect of a company that grows its earnings, grows its market, finds better ways, cheaper ways, and more effective ways to bring its services and products to the markets, that has been the best way long term to put money to work. American companies grow at about 6 to 8% a year before the yield of a dividend. So if you're looking historically, you're looking at something that returns about 7 to 10% if you don't know what you're doing. If you're just buying an index and doing nothing. Now, what's happening, for example, right now? Mm-hmm. If you're 64 right now, things are not looking great for you, because if you had $1 million, because you asked the $1 million question, then you sign 1 month, that $1 million go to $650,000.
Right.
So you lost a third of your retirement, in that particular scenario. So that's where education is necessary, because while the markets compound beautifully over time, and over time is the key word here, there are instances within them where you're more at risk. If you need mm-hmm. the money now, then there's things you need to do to diversify and not put everything in the markets, because at any time, especially after a 12-year or an 11-year bull market, you're risking the fact that there will be a correction, there will be a pullback, there will be a mini bear market or bear market, which is defined as a 20% or more loss for your equities, for your paper worth. So, Kyle, the best answer I can give you is, over time, stocks have been the best performing asset class. So if you're a child, like if my kids, I put 100% of stocks for them, their money. But if I'm moving up the ladder and I'm 35 to 45, 55, then I start to diversify differently. Historically, people have moved out of stocks and they put it into bonds, because bonds, obviously less volatile, always liquid. The big bonds, right? The government bonds, etc. Mm-hmm. They're always liquid, and they used to pay a yield. In our world, bonds don't pay a yield almost unilaterally around the world. All governments are either at 0%. They offer you 0%. So if you want to lend Washington money right now for 10 years, you'll get about 0.6% for doing so a year. So if you are a retiree, you say, okay, I don't want to risk anything in stocks. I want to put everything in bonds. I'll lend Washington money. I'll lend them $1 million. You're getting 0.6% every year. That translates into nothing. If you factor in inflation, you're even losing money. So that's the big change in today's world. How do you diversify where there is no income in bonds, which traditionally used to give between 4 and 5% a year throughout the 20th century and up until recently for the 10-year bonds. So that's the best answer I can tell you. The second thing is real estate. So real estate comes after stocks in terms of ultimate returns, and especially if you're looking for passive returns.
So I think this is really important because, 3 weeks ago, and this is part of the reason why, we're changing things up. And my goal is to not just sell my audience with, you have to do real estate. My goal with my audience is to provide the best value so that they can go out and make choices that make the most sense for them. There was just, we had this whole, I posted very simply on Facebook the other day about my aha moment of whole life insurance and how it could be a great vehicle for my real estate. And all these people come in and, everyone's got their own opinion, but everyone's got their own opinion because it's their their situation, it's their understanding, it's their experience. And so they have this preconceived. And so,
Okay.
people who come
Do you
in
use
and
Paradigm Life, by the way?
what's that?
Do you use Paradigm Life in Utah?
Tell me what that is. I don't even know what that is.
The whole life insurance that you're.
Oh yeah, no,
using.
I'm just researching at the moment right now.
Okay.
Yeah,
Okay.
yeah. So
I have one. That's why I'm asking.
okay, got it. Well, I'd love to know more about that. So I guess the point I'm making here is that I want to provide the most value to our audience. And here's where you coming in from a different perspective, from a non-real estate minded perspective like me, I think is going to be really valuable. So I really want to dig deep here. And you mentioned something I think is super important for some people that are listening in, actually really to everyone that's listening in, because whether you are retiring or you're not retiring, you know someone that's probably either in retirement or close to retirement that is having this happen to them right now and has no idea what to do. So I guess my question, Lior, is someone's in that position. They're either retired, they're 1 year away from retiring, or this is impacting their retirement. What in the world should they start doing?
Well, first of all, I do not know anyone, to be honest. So what I'm saying is a generalized advice. It's not
absolutely.
It's not anything that's personal advice or anything like that. But what happened now with coronavirus caused the mostly retail investors, so not institutional investors, not sovereign wealth funds, not the big money, not the smart money, not pension funds. It caused the retail public to sell. What you saw in 16 days, a minus 35% decline on the indices is mostly because people like you and I sold at a rapid pace. Now, I personally did not sell a single company that I own, and I even bought during this time.
Yep.
Because I'm 35, and whatever happens now, even if you look at the worst managed crisis of the in American history, the Great Depression, it took 7 years to go back to break even if you bought it a day off the top, including dividends. So even at that, at 42, you're made whole, even if they manage this in the worst possible way. And we're not there. I can give you a lot of comparisons between them because I've studied both periods, and we're definitely not at any in any capacity like we were in 1929. But if you're approaching retirement right now, what you need to ask yourself is, first of all, what did you do in the last 3 weeks? If you sold, then you already realized your losses, and now you're at this basically a dilemma, because your dilemma is, how do I make up for this? The trick is that most people, when they want to make up for this, will take bigger risks, because they'll say, hey, I lost 35% in 3-4 weeks. How do I make that up? Now, to give people an idea, if you took $1 million and you now have $650,000, that's a 35% loss. To make it up, you need to make 50%.
Okay. Walk me through that.
650. If you want to make that 350 back, 350 over 650, you need to make
50% of the 650. I got you. Okay.
Yes.
Okay.
So you're thinking to yourself, how can I make 50%? And that's a big ask. So the first question is, what did you do during this panic? If you already realized losses, then you're in a worse situation, because now you have to literally make 50% in ways that might not be at the same risk tolerance that you're used to. If you didn't realize the losses, then most of the losses have already jumped back. And now you need to ask yourself, hey, I'm 60 something or I'm 50 something. How much of this money can I take off the plate and put in other vehicles? And what other vehicles should that be? Whenever you approach retirement, the appetite to be in stocks should start to diminish for you, if that's the only income you're banking on. If you have active income, then it's not such a big problem. But if everything you're looking to fund your lifestyle with is this nest egg of equities that dish out a dividend, or even if they don't dish out a dividend, that income it is problematic. So the first thing I would say is you should keep some active income in place. That will be great for your mentality, for your spirit, for everything. I just do not believe personally in the concept of a full retirement.
Yep.
It is not healthy for the individual to not be creating something.
Right.
So it could be something that you do, that you love to do, and it may be something that's very cheap in terms of the income. It's not something that you provide a lot of value, but you just enjoy it. So the income from it may not be that big, but you're still earning something. Or if you have a lot of experience, there's so many things that you can do that are home-based, that are freelanced, that are on a consultancy basis, even just an abundance of things. There's so many problems in the world, and if you know how to solve them, then that's something you should do, and you can trickle back and put in Florida if you want to. So I think that's number one for me. If you are the type of person who doesn't mind keeping an active income stream, do that. Don't lose that part of your life. And it can be very part-time. Now, where do you put your the money that you take off from the markets? So one thing you can do is put it in rental real estate. And I love rental real estate for three reasons. One, in today's world, the post-2008 world, you don't need to go out with a realtor and find a single-family house, and you don't need to go through all that hassle. There are several platforms that are really great, even if you're not an accredited investor, where you can put even micro sums at play and diversify them between tens and even hundreds of projects. And I'm talking projects that on your own you cannot participate in.
Right.
So you can be a part owner of a building that's rented to CVS. As an individual, good luck with that. But here you go.
And what we're talking about basically there, the name of that is syndication, just so our audience knows. There's a lot.
So Fundrise.com, for example, Pier Street, I can name Realty Mogul, etc. There are a number of them that are bigger. There are others that are more boutique. There are literally tens of them, but some of them are only for accredited investors. Some are for all types. So it just depends on where are you on that spectrum. But yes, the post-2008 world is a world where there's a lot of institutional money in real estate, and you don't need to be that guy that drives around with his realtor for 40 hours a week and tries to find the perfect house and put a lot of risk into one project. So I think that's something that's interesting. Obviously, with REITs, both private and public, you get to invest in all sorts of real estate, Kyle, that you wouldn't have a prayer to do on your own. You can invest in mini storage complexes. You can invest in companies that rent to the federal government. You get the point.
Yeah, a lot of options there.
Yes, and the yields are between 8 to 10%. Not like bonds. Okay. Secondly, you can do some lending. So private lending, which is also not in the stock market, and that's where you can also invest micro sums or lend micro sums to everyday people. The default rates are incredibly low, and the yields are between 6 to 8% as well. Another great idea. Now, for me personally, what I also love is the concept of precious metals. I've been a big believer in precious metals. If you go to our website, to wealthresearchgroup.com/gold playbook, it's actually the most comprehensive gold and silver investing manual online.
Okay.
You could download that for free. Now, with gold, what I like is if you go back to the year 2000, Kyle, and you compare the gold with the stock market, gold has actually outperformed stocks.
Okay.
So an ounce of gold back in January 1st, 2000 has compounded better. An ounce of gold, it does nothing. It produces nothing. It does nothing for you. Put it in your pocket the first day of this millennia, and you look at it 2 decades later, and it's worth more than putting in your pocket the best 500 companies in the world and looking at that 20 years later.
So real quick question about that. Since that has grown more, why do you believe still stocks over gold?
So the fact that the S&P 500 has not returned as much as gold on a 20-year period, while that is rare, that can happen. Individual companies within the S&P 500 have grossly outperformed gold. So the index, which is basically like buying the 500 biggest companies in America, is not, sophisticated investing, right? It's like the easiest type of diversification that you can have within the stock market. So it is rare, though. So why has gold performed so well? It is because all governments since the year 2000s are running on giant deficits, and they have slashed interest rates down to zero. When you make interest rates zero and there's inflation within the economy, the value proposition of just holding cash as is diminishes significantly. And what you start to do is you start to look at what can I save my purchasing power at that is very historically sound, is not volatile in a way that I can't stand, and is very proven. Gold answers all the above. And it does one more thing. It is nobody else's counterparty risk. So in other words, a bond, you need to make sure that the borrower pays you back. A stock is a company. A company can go through many trials and tribulations. A fiat currency or a national currency is not under your control. How many units they end up circulating, as you can see right now with a $12 trillion that they're basically adding to the money supply, you have no control over that. When you own gold, you own it straight up. Even when you own a house, if you don't pay your taxes, they can take your house. So even your house, free and clear, is not really your own. There is some counterparty risk. An ounce of gold is literally yours.
I've never heard it put that way. That's really interesting.
Yes. So it's literally, you own it. And that is done. It's like a furniture, right? You own that piece of couch. It's not somebody else's liability at the same time. But with gold, it compounds up. Whereas a car or furniture or whatever, your computer, it depreciates. What does gold do? It reflects the amount of inflation, inherent fear and risk in the business community. And it also reflects how much governments are fearful of other governments. When the world is being globalized and open borders, then the price of gold usually is not attractive. But since the year 2000, since 9/11 and 2008 and all of these, the Greek default in 2011 and everything that's Brexit, etc., all of these major changes to the world's economy are creating a situation where more and more people want to at least in some way convert some of their purchasing power from fiat currencies to gold. What I personally did in my own case, I took 24 months worth of my living expenses, my family's living expenses. So let's say we spend as a family $10,000 a month, right? As an example. I took 24 months of that, so $240,000, and converted them into physical gold and silver, mostly gold. And if there is a recession or even a 2-year recession, then I have savings that if the government ends up doing what they're doing right now, which might be very inflationary, I have something aside that I owe nobody else. And it's literally mine. And usually in crisis time, it appreciates. So that's sort of a start over fund if everything goes rotten. Now, it happens to be also a wealth compounder, because if you look at that idea, if you've owned gold for 10 years, you've made great returns. Or if you owned it for 20 years, you made phenomenal returns. So it's not only been a form of savings, it's actually been a form of wealth. if companies, actually, if publicly traded companies, if pension funds, if sovereign wealth funds would have held more in gold than in their own currency, then everyone would be better off.
I love it. All right. So this is really good stuff. And I'm going to do what the Wealth Research Group does. And I'm going to summarize exactly what you just said here. So,
Okay.
So what I heard was three main things. The first thing was, it was a combination of both. All right, you've cut your losses, but also learn from it next time. Like if you're going to, the big thing I took away from that is people need to understand that if you're going to start pulling out money and then you're going to put it back in, it's got to almost double the performance sometimes in order to get back to where you originally were. So in other words,
Yes.
if a dollar is now worth 65 cents and you pull that out, if you hadn't pulled it out, you just needed that dollar to go back up to $1, which is essentially 35% replenished. But now if you're pulling that out and then you're putting it back in, that 65 cents is now your new dollar, and you need that new dollar to be $1.50. You need it to perform at 50% rather than 35%. So learn from that, understand that. The second thing was, if you're going into retirement right now or thinking about retirement, keep something active, keep something that is going to keep you alive, emotionally, spiritually, physically, that's going to feed your soul, that is going to make you money and is going to help you to continue to live a fulfilling life. And then with that extra money, if you do have it, or once you have that after you've continued the active income, put it in something real, real estate, be a private lender, put it in metals, golds, and that can be your wealth compounder, just like what you said there, Lior. So is that a good summary?
Yes, and I have one note for each of them.
Yes.
So for the first one, understand this: in the past 100 years, as I said, the average return of the S&P 500 is 8% a year. But Kyle, out of those 100 years, only 4 years, have actually returned 8%. Okay, let me say that again. So if you put your one hand in steaming water, like crazy hot, and the other one in ice water, that's usually how markets behave. They're either crazy hot or they're not, or they're pretty cold. But on average, if you take this bucket and you fill it in, you create nice water, right? So that's what's happening. Usually the markets are either up 20, 25%, 30%, 3%, they're down 10, whatever. They average out to 8%. But in actuality, only 4 years in the past 100 years, the markets actually stood on that average. So, like you said, they go down 35. In 1 year, they can be up 35 and more. If you sell, what you do is you create a taxable event. That's one thing. You lose your compounding. So when you own a stock, you own a piece of a company.
Right.
You sold a piece of a business, and you need to think for yourself whether or not that business was that impacted by the coronavirus that it will
not recover.
The value to the consumer, to its clients, has been diminished. Let's take an example. American Express went down from 135 a share to 70 a share in 1 month. Wow. So almost a 50% loss. Has American Express lost its value to its customers by 50%? Is it worth 50% less because of a virus?
Right.
If you can make that judgment call, then you can do something about it. That's what I'm saying. So that's the first thing. And then the second thing you said was keep active income. The entire life insurance industry and pension funds and everything like that are based on the fact that when they retire at 65 or 67, they lose basically a lot of the zest for life, and they literally expire at 72 or 73 or 74 because they're bored.
Exactly.
So active income is good for you. Literally, it's good for you. And then the third thing you mentioned, I'm sorry, could you just say something of it? And
you said basically creating that wealth compounding, that passive income.
Yeah. So with gold, for example, what's really important about it, and I haven't said that, it inversely correlates to basically all other assets. So in a downturn with stocks, gold is up this year.
Based on what you said, that doesn't surprise me.
So it's positive. And when you think about it, that's pretty amazing because we've lost 8% of the global workforce. 195 million jobs are lost.
Yeah.
About $5 trillion of GDP. So that's a quarter of American GDP is lost. And yet gold is up. And so that's what I also like about it. It inversely correlates to real estate prices, to everything that's great about the world, right? The world is growing richer, etc. Gold is no. If there's a problem, I'm here for you. So, and that plays into diversification.
That's awesome. All right. Well, Lior, you've provided a ton of value today. I do want to give people an opportunity to be able to continue to get value from you. Obviously, just Googling your name is going to get them far, but going to wealthresearchgroup.com. You've also got a special offer for our audience. Can you share that?
I literally just published a book, my first book, and it's free. So because of what's happening right now, because everyone's home, and I just want to make sure that people have something nice to read, I hope nice, then you can go to wealthresearchgroup.com/book. You just download the ebook. Done.
That's awesome. Perfect. And then we've also got a link that we're going to drop below that is another special offer from you. Can you explain that a little bit?
Yeah. So what we've done is we've partnered with a very good trader that usually does not share his information if you're not like a big client, a $500,000 client, etc. He consults with big clients because he's a personal friend. I told him, look, let's just bring this down to some price that if somebody says, I don't want that, then he's probably not serious about his wealth and well-being, etc. Yep. So he said, why don't you do that? Why don't you give them my top ideas at $129? And I said, okay, that's obviously a no-brainer. And that's what we did. So if you go to wealthresearchgroup.com/Kyle, then your audience can literally just download that report. It has 6 ideas on how to bounce with the coronavirus recovery, what to short if you're looking to short, or just to avoid, what sectors to avoid, and a special Warren Buffett strategy that this person has used his entire investing career. And since he has a lot of background with the military and stuff like that, there's a lot about self-sufficiency and what to do in that regard, and it's only $129. Again, wealthresearchgroup.com/Kyle. You just purchase it there and download the report.
Wow.
And it's yours. Yeah.
Wow. So some of the biggest clients in the world have been getting this for a while from this guy, but he's willing to give it for $129 to our audience. So that's pretty special.
I had to bend some, it took some time, but literally we live in a world where right now there's a lot of goodwill out there. And this is sort of a goodwill.
It's really awesome. Well, again, wealthresearchgroup.com/Kyle. We'll throw that into the show notes as well. Stay tuned to the end here to get the link for the show notes. But Lior, you have created so much knowledge and value today for our audience. So thank you so much for helping us to conquer investing and being a part of this very interesting times.
100%. Thank you very much, sir.
Hey, everyone, don't leave quite yet. I've got something really special for you. Lior actually called me up right after the interview about a day later and said, hey, listen, because this thing is brand new, I really want to give people an even easier option of getting in, especially your listeners. He told me that. And so if you actually type in the code 2020, you are going to get a $60 off that $129 resource that Lior was talking about. So again, you're going to go to our new show notes page, or if you're watching on the YouTube channel, the link is just below. The new page, if you go to fearlessflipping.com, it'll still redirect you here, but now it's fearlesskyle.com. And you're going to be on /Lior, Lior. So once again, the code is 2020. You get $60 off. That makes it a total of $69. And you get everything that Lior talked about there just for $69. If you go to fearlessflipping.com /Lior, Lior, and the link will be right there with the code 2020. Now that is it for the very first episode of The Fearless Investor. And I really hope that you enjoyed it. I hope that you take advantage of all the resources that Lior was talking about. And one thing I really loved that he was talking about was having fulfillment. having excitement about what you're doing. If you do something for the money, if you do something just for the opportunity of it, you're probably not going to stay in it very long. You got to do it because you love it. And that was what I loved about what Lior had to say. That's it for the Fearless Investor. Go out and conquer the world of investing. We'll talk to you next time.